Right now, something extraordinary is unfolding in the silver market that every investor needs to understand immediately. For the first time in history, a major exchange has publicly confirmed what many have suspected for years. Organized manipulation in precious metals markets is real, and the perpetrators have been officially caught. The Shanghai Futures Exchange just released a formal regulatory document exposing coordinated trading groups who dumped an unbelievable amount of paper silver contracts in a single session. This isn't internet speculation or conspiracy theories. This is official regulatory action with documented evidence, announcement numbers, and verifiable facts. Whether you currently own silver, are considering precious metals investments, or simply want to understand what's really happening in global financial markets, what I'm about to share will change your perspective completely. Welcome to Con Invests, where you get honest, fact-based market analysis without the hype or hidden agendas. I don't sell you anything. No premium signals, no investment courses, no schemes. Just straight information based on real data so you can make your own informed decisions. If you find value in this content, please hit that like button and subscribe to stay updated on critical market developments. Let's start with the facts. On February 5, 2026, the Shanghai Futures Exchange issued official announcement number 37. This was a formal regulatory statement, not a social media rumor. The announcement clearly identified 6 groups of connected trading accounts that violated intraday position opening limits on silver contracts. These weren't random traders making honest mistakes. These were coordinated groups executing a planned attack on the silver market. The exchange has now restricted these accounts from opening new positions, essentially banning them for market manipulation. To understand the current situation, let's look at the price levels. Western spot silver is trading around $74 per ounce. Shanghai spot price sits at $82 per ounce. Shanghai silver futures are at 99 per ounce. This creates an $8 premium for Shanghai, meaning physical silver in China commands significantly higher prices than paper contracts in Western markets. Here's how this situation developed. A Chinese billionaire apparently built one of the largest documented net short positions in silver history. Then, during one morning trading session, 674 million ounces of paper silver contracts were dumped onto the Shanghai Futures Exchange. Let me give you perspective on that number. Global annual silver mine production is approximately 800 to 850 million ounces. That means in a single morning, someone dumped nearly double the entire world's annual mine production onto the market. This wasn't normal market activity. This was a calculated attack designed to crash prices. The Shanghai Futures Exchange responded immediately by banning the 6 groups of linked accounts and citing abnormal trading behavior. This is now official regulatory record as announcement 2026-37. While this was happening in Shanghai, equally shocking events were occurring at the COMEX exchange in New York. 3 million ounces of physical silver were withdrawn from exchange vaults in a single day. Even more unusual, futures contracts are now settling at 100% physical delivery rates versus the normal 1 to 3%. Total COMEX inventory has declined to 400 million ounces and continues falling daily. The CME, which operates COMEX, just announced their third margin increase in 10 days. Maintenance margin requirements jumped 11% for gold futures and a massive 20% for silver futures. Think about what this means. Exchanges are raising margin requirements even though prices are declining. Normally, when prices fall, volatility decreases and exchanges lower margin requirements. They're doing the exact opposite. The CME raised silver margin rates again, pushing requirements to 18% from 15%. The average true range on silver futures reached a record $14.17 per ounce, representing 19.3% volatility. But exchanges don't raise margins because everything is fine. They raise margins out of fear. They're genuinely concerned that something might break in the system. If gold were the main concern, gold margins would increase more than silver margins. But silver is getting hit with a 20% increase compared to only 11% for gold. High margin requirements equal stress in the financial system. Stress equals positioning risk. Positioning risk means too many large traders are on the wrong side of trades, and the exchange fears mass defaults. Here's something crucial. You can increase margins on paper futures contracts. You can force traders to deposit more cash, but you cannot margin call physical scarcity. You cannot create actual silver bars when vaults are running empty. That's exactly why silver is getting hit first and hardest. Yesterday's forced price crash reduced COMEX total futures open interest by approximately 6,000 contracts. Total open interest dropped to roughly 137,700 contracts. The long positions, meaning people betting on higher silver prices, aren't short-term speculators. They're holding firm and waiting for physical delivery of actual metal. Open interest remains dangerously high compared to registered silver actually available in COMEX vaults. Currently, we have 688.5 million ounces of open interest. Contractual claims on that amount. But there's only 103.3 million ounces of registered silver in vaults available for delivery. We're rapidly approaching a critical point where either the COMEX system breaks completely or the big banks manipulating prices finally break. The CME March 2026 futures contract has its first delivery notice in just 3 weeks. Here are the only 3 possible paths forward. Option 1, they somehow locate massive amounts of physical metal to deliver. Option 2, they force out the short position suppressing prices, allowing prices to rise naturally to where supply meets demand. Option 3, they declare force majeure, essentially defaulting by announcing they cannot deliver physical metal and will settle contracts in cash instead. Those are literally the only options, and none favor the price manipulators. There was a massive drain from Shanghai Futures Exchange vaults. They're now down to only 350 tons of silver, equal to approximately 11.2 million ounces total. These artificially low prices create huge problems for exchanges because low prices accelerate physical reserve drains when there's already a severe shortage. The Shanghai Exchange lost 15% of its total vault inventory in just 1 day. Let's examine the COMEX March delivery crisis. COMEX data clearly shows the March delivery period starting February 27th faces an accelerating physical drain that could overwhelm all available silver. Total COMEX silver deliveries in 2025 reached 474.4 million ounces, more than double the 202.7 million ounces delivered in 2024. Every month throughout 2025 showed higher deliveries compared to the same month in 2024. Market participants are abandoning rolling contracts forward and demanding physical metal instead. January 2026, typically an extremely quiet month for deliveries, exploded with 49.4 million ounces delivered. People are front-running the March delivery because they're worried about getting physical metal later. When minor delivery months suddenly become major delivery months, it signals real fear. February 2026 has been even more shocking. In just the first few days, nearly 19 million ounces were already delivered, almost matching the entire February total from last year. Almost 100% of open interest is standing for delivery, way beyond the normal 5 to 20% rate. This market isn't functioning like a normal futures market anymore. It's becoming a physical metal grab where everyone wants actual silver bars, not paper promises. Current open interest sits around 429 million ounces. If just 25% of contract holders demand physical delivery, that's over 100 million ounces needed. At 50% delivery rate, we're talking about 214 million ounces required. If 70% stand for delivery, we're looking at up to 300 million ounces demanded. Last year's March delivery was already severely stressed when 80 million ounces were delivered. The registered silver available has plummeted from 167 million ounces in October 2025 down to approximately 103 million ounces now. That's a 38% drop in just months. Based on current drain rates, vaults are losing approximately 785,000 ounces per day from registered inventory. By the time March delivery starts, we could be down to approximately 85 million ounces available, dramatically short of potential demand. There is eligible silver in vaults, but owners aren't converting it to registered status at these low prices. They're holding out for higher prices. Even if March deliveries only match last year's level of 80 million ounces, that leaves almost nothing for May's rising open interest. If this drain continues, later delivery months will face the same supply squeeze. A shortfall could force cash settlements, trigger force majeure declarations, or completely shatter confidence in the paper pricing system. Yesterday's brutal cryptocurrency sell-off triggered broader deleveraging across all financial markets. We witnessed heavy liquidations in tokenized silver products, and that selling pressure fed into COMEX futures, silver ETFs, and swap contracts. Another $350 billion was wiped from total crypto market cap. At the lowest point, crypto gold and silver combined were down a staggering $2.4 trillion in one day. The silver-to-gold ratio has been tracking Bitcoin's price movements closely. In previous major sell-offs, Bitcoin started weakening ahead of the silver-gold ratio, acting as an early warning signal. Institutional investors are aggressively unloading U.S. equities. Hedge funds sold U.S. single stocks at the fastest rate since October. This marks the fifth day of net outflows over the past 6 trading sessions. 5 of 11 major market sectors experienced heavy liquidation, led by information technology, industrials, and materials. Semiconductor stocks and tech hardware faced the heaviest selling pressure. Geopolitical tensions are also escalating. Everything is selling off at the same time. Gold, silver, crypto, stocks. That synchronized selling doesn't happen in normal free markets. It only occurs under extreme manipulation or severe systemic stress. But here's what's fascinating. Silver prices are falling, but physical inventory in vaults is also falling dramatically. That tells you physical metal is actively leaving the system, while paper contracts artificially force prices lower. When exchange vaults drain during sell-offs instead of filling up, it reveals everything. The price move is financial paper manipulation. The demand for actual physical metal is real and growing. We're witnessing a growing disconnect between paper silver markets and physical silver reality. Paper short sellers are aggressively pushing prices lower on futures exchanges. Meanwhile, physical buyers are using those lower prices to systematically drain available stockpiles. Paper contracts can suppress prices temporarily. Physical buying permanently removes actual supply. Reports from Singapore show people literally queuing for physical gold despite falling prices. Retail investors crowded into United Overseas Bank Limited, Singapore's only bank offering physical gold. We saw similar physical buying trends in Australia, Thailand, and China. Physical demand isn't collapsing. It's actually accelerating as smart buyers recognize the opportunity. Paper-silver market activity has spiked to unprecedented levels. The largest silver-backed ETF, called SLV, saw its trading volume hit a record-breaking $41 billion on Friday. SLV trading activity was higher than any individual stock in the world. That extraordinary volume indicates violent position changes, forced liquidations, and capitulation selling on a massive scale. The last time silver traded near $65 per ounce was mid-December. Back then, the 14-day RSI was pushing 80, indicating extremely overbought conditions. Market sentiment was euphoric. Today, silver is at the same $65 price level, but now the RSI sits around 30, indicating severely oversold conditions, and sentiment is panicked. Same price, completely opposite sentiment. This doesn't automatically guarantee the bottom is in. We still need confirming data. However, the sentiment difference is striking. The entity that crashed silver 47% in just 7 trading sessions moved with extreme urgency. When price moves happen that violently in one direction, reversals can be equally violent. The CME margin hikes are forcing additional liquidations. This is the 3rd increase in 10 days. Bitcoin is clearly leading the overall risk-off market move, and the silver-gold ratio is tracking Bitcoin closely. As long as Bitcoin remains under selling pressure, downside risk for silver persists. Cryptocurrency markets are down 46% from recent peaks. Hedge funds are dumping equity positions at the fastest pace since October. When everything sells off together, it represents systemic deleveraging across the entire financial system. But here's the massive structural tension. The Shanghai Exchange has officially confirmed through regulatory announcement that there was a coordinated short attack on silver markets. They've banned 6 account groups for market manipulation. COMEX registered silver has fallen to just 103 million ounces. Open interest represents claims on 429 million ounces. The March delivery period starts in exactly 3 weeks. Shanghai vaults lost 15% of inventory in a single day. We're witnessing 100% physical settlement rates on COMEX versus the historical normal of 1 to 3%. People in Singapore, Australia, Thailand, and China are forming physical queues to buy despite falling paper prices. Physical demand remains relentless. The paper manipulation games are being exposed through official regulatory action. The unresolved question is, does the March delivery period break the COMEX system entirely, with 429 million ounces of open interest claims against only 103 million ounces of registered inventory? Or do margin hikes combined with risk-off moves force enough liquidation before the physical shortage overwhelms the paper system? The Shanghai Exchange is cracking down on coordinated short sellers. Shanghai vaults lost 15% in one day. People are queuing for physical metal despite falling prices. The system is showing visible cracks from both regulatory and physical supply standpoints. We are exactly 3 weeks from the March 1st delivery notice date. The fundamental math clearly says a severe shortage is coming. The risk-off selling says additional pain remains possible short-term. Which of these two massive opposing forces ultimately wins will determine the outcome.